Good day and welcome to this risk readiness webinar. My name is Carly Edmondson and I am the Senior Product Manager of Business Solutions at the Risk Management Association. RMA is proud to make this presentation complimentary to members. If you're not a member, explore all RMA has to offer at rmahq.org. Today's webinar is the latest installment of Credit Trends in Commercial Lending, Credit Risk Navigator, presented by Tom Cronin and Jeremy. During the presentation, if you have a question for the speaker, please submit using the Q&A feature at the bottom of your Zoom screen. We will address as many of your questions as we can at the end of the presentation. With that, I'd like to turn it over to Tom Cronin from AFS. Thanks for joining us today, Tom.
So thanks, Carly, and welcome to everyone today. Before we get to the February results, I wanted to take a minute to answer a question that I've received from two of our CRN Credit Risk Navigator dashboard users. And the Credit Risk Navigator is what powers the data that you're going to see today. The question concerns the main chart on the executive summary page, which I'm showing here. And as we've mentioned in past webcasts, CRN started in 2003, and the main chart displays the results for the entire length of the service, starting in 2003 on the left, going over to 2022 on the right. And the question from the user is, can a user limit the amount of time shown on this chart? So what they really want to do, instead of looking at 2003, just look at some of the more recent time periods. And so I thought I'd take a second and show you how to do that. So the way you do that is in the upper right of the main chart, you see in the dotted circle, quarterly view. So you change the view from year to quarterly. And then you can use the big green arrow there as a slider, and you can pull it over to see your most recent data. And then you go into the upper right-hand side of the chart where we have our time filters. And for those of you not familiar with CRN, you can see the various dimensions here, collateral, geography, size, market. This particular one we're looking at is time. You go into the time filter, you scroll down to, say, here I've selected October, November, and December of 2021, and you do that by doing Control-Shift. Control-click, highlights those. You go back up to multiple selections, say apply, and the chart is changed just that quickly to the 3 months that you see here. So as you've seen, those of you who use this, and if anybody's seen a demo before, the dashboard behind this is very easy, very friendly, very easy to use. And I just want to take that time to answer that particular question. So I'm going to start with C&I data. And as we've mentioned before, we define C&I as loans, business purpose loans to companies usually with annual sales north of $1 million. And again, these are business purpose loans as opposed to, an executive buying a car. These are, and owner occupied real estate is in here. CRE has investor owned real estate. So for February 22, and just another note before we get deep, we're going to take an extended look at performance measures this time. You can see here's our C&I performance chart starting again 2003 going through February of 2022. And we continue to see an overall improvement in the major performance measures. Non-accrual loans were down, actually down percentage points, very few percentage points, but now we're still down, and we're back to pre-recession levels. Short-term delinquencies, as we've mentioned for the last 2 years, again, very volatile, but now are continuing to show signs of going down, back close to where they were pre-pandemic, not quite there yet. And again, long-term delinquencies, which you see in the darker green line, that's 6 to 89 days, they spiked up, but they're still relatively low compared to where they were, say, during the recession period. So all in all, the performance, the C&I performance is looking very good. You had the impact of the pandemic, and that seems to have recovered very well from that point. So let's take a look. We're going to look at delinquencies and non-accruals, and we're going to first start off with delinquencies. And I'm going to look at short-term past dues because that's the primary, that's where most of the activity is. That's the largest amount of activity. So the percentage past due here is for each 2-digit NAICS code, and the horizontal line, the dotted horizontal line, is the all industry average. And the most noticeable above the line, as I've heard me before, is 55 management of companies. And we've mentioned this before. This is sort of a catch-all category. I think we used to call these conglomerates. There's not, first of all, there's not a lot of dollars in here. So from a relevance standpoint, this isn't really highly relevant an industry on the overall picture. But these companies in here tend to make investments that are higher in risk and reward. So it's not really surprising that their past due level is up. If you come back over to the left side, the heightened level for ag is not surprising, especially due to a couple items. One, the extreme drought conditions in California, the increase in the cost of diesel fuel to run tractors and other equipment. And now on top of all that, we have an impending shortage of fertilizer due to the ban on Russian imports. So ag looks to be getting hit from several sectors. What does surprise me here is, now going all the way over to the right, apologize for moving you back and forth, is the 1.5% past due for 92 public administration. This usually is one of the best performing sectors. And when we took a little deeper look at this, the 1.5% is a delinquency for a single facility in Missouri. And that facility was made by a bank that was operating outside its normal footprint. And we've mentioned that delinquencies are volatile. So I suspect this is going to come back down next month in March. But if it doesn't, we'll take a deeper look and see what's going on there. But again, that's a single facility by one bank. And at the end of every Credit Risk Navigator webcast, we've asked that you complete a very short survey that asks what you thought and what you'd like to see. And if you've been with us before, you know I use those comments to augment our analysis. And this chart is a result of a survey request to see performance stats by regions or geography. And in Credit Risk Navigator, we tag a borrower as being in a specific region based upon the location of the borrower, not the bank. So if a bank in Vermont makes a loan to FedEx, that borrower appears as being from Tennessee, or here it would be from, I think, the Eastern Midwest. And by doing that and looking at 30 to 59 days past due, we're seeing issues or elevated past dues on the East and West Coast, so the Northeast and the West. Good performance in the Heartland, the Eastern Midwest, the Mid-Atlantic, a little bit in the Southwest, and then the South is the best. Okay, so we want to stop here, Carly, and I think do our first poll question.
Yes, we have a poll for you that I just launched. The question is, in general, do your larger loans perform, oh wait, let's see, launch this one. In general, do your larger loans perform better than smaller loans, worse than smaller loans, and about the same as smaller loans? Also, while we send this out, I will let you know that it looks like, thanks Dot for letting us know that it looks like the presentation didn't go out. I just went ahead and sent it. So hopefully you'll be getting that in your inbox to follow along a little bit more easily. So thanks to Dot for bringing that to our attention. So we have about, let's give everyone another 30 seconds or so to share, and we're at about 49% of folks have participated. Wait 10 more seconds and then we can go ahead and share the results. Okay, we'll end it and share the results. So it looks like we have 58% said in general, larger loans perform better than smaller loans. and 42% said about the same as smaller loans. So we have some information on this next slide that may make you rethink that. So why don't you go ahead, Tom, and show what Credit Risk Navigator has found.
Okay. So obviously that was a loaded question. We were really curious what people thought, and here's what we wanted to show you. So on the left side, that's not a mistake. It is March 2012. So 10 years ago, this is what you would see. And I think 58% of the people said their larger loans are better than their small loans. And 10 years ago, that matched exactly. You see the stair step coming down. The larger you got, the better off. And again, we're looking at past dues, the better off you got. Then if you move over to the chart on the right, this is February 2022, and you can see quite a difference. So loans less than $1 million, or actually less than $1 million, are performing better than average. The problem loans, if you will, are in the kind of the middle, the traditional middle market area, 1 to 3 million, 3 to 5. Those companies that were too big to get PPP, but too small to have access to equity markets. And then you also see some issues with participations and syndications. A lot of the parts and syndies are to companies such as agriculture and 55 management. So we have an idea of why they're doing poorly. But for what's happening with February of 2022, I want to hold off for a second until we get to the non-accruals, and then I'm going to try to explain what's happening. So if you bear with me, let's go take a look at non-accruals, and we'll come back to this. So here's non-accruals by industry. Again, the dotted line shows you the average. And for the first time since 2015, 21 mining, oil, and gas is no longer the worst performing sector as measured by non-accruals. And just a year ago, February 21, the non-accrual rate for oil and gas was 8.4%. So now it's just a shade over 2. Obviously, this is due to the result of the increase in oil prices and gas prices, as we're all experiencing as we drive, if we drive to the office. And now agriculture has become the worst performing sector. And if you're on our webcast last month, you heard from our panel of bankers that one of their concerns involved the agricultural industry. And here you can see ag is now, as I just said, the worst performing sector. And we've mentioned the headwinds, drought, increase in supplies, fuel and other supplies, and what will now be coming the shortage in fertilizer from Russia. Other industries that still remain elevated from COVID hits, 71 and 72. So the arts, entertainment, and rec, and then accommodation and food services. Most of that is restaurants. And then 33 manufacturing is continuing to deteriorate it. And we had said that we would watch this and report on what's happened. So I wanted to just take a second to talk about that. If you look at February 21 versus February 22 at the next level down from 33, so the third level of the NAICS code, we're seeing elevated levels for all of the subsectors in manufacturing, 33 manufacturing, with the exception of computer manufacturing. Computer manufacturing is doing okay. And we see large increases in furniture manufacturing, transportation equipment manufacturing, and sporting goods manufacturing. And then we're also seeing increases for other types of manufacturing, such as metals and machinery, but those aren't as significant as what we're seeing with furniture, transportation equipment, and sporting goods. And that has all been, again, something that's changed just over the last couple of months. And particularly the furniture, a little bit surprising given the level of house buying that's going on. So again, we're going to keep an eye on this and see if it doesn't appear to be temporary. We'd want to check out and see exactly what's going on. Here's non-accruals by geography, so the regions. And since most of the oil and gas loans are from the Southwest or are in the Southwest, it's not surprising that the Southwest is no longer the worst performing region. That distinction, the worst performing region, is now held by the Eastern Midwest, followed by the Mid-Atlantic. And within the Eastern Midwest, we find the highest non-accrual levels in the state of Michigan for the following industries. And these are going to sound very familiar to you. 71 arts, entertainment, and recreation, 11 agriculture, and 33 manufacturing. So now we're back to the deal size and the performance by deal size, and back to your polling question. So here, if you look at deal size by non-accruals, this is historically what you thought you would see. Again, the stair step down, the smaller loans doing not as well as the larger loans, primarily because the smaller loans just don't have access to the capital markets that the larger loans do. But you're seeing, remember, you're seeing something different now for the past dues. And so we took a deeper look at this, and I hope I explained this well so that everybody understands what's going on. And what we found is that the industry mix for loans less than $1 million has shifted since the end of the recession. So I'm talking since 2010, 2011, 2012. If you look at the active or paying loans, so not the non-accruals, they are now loans to industries that have proven to be less risky. The balances for loans less than $1 million made to better quality industries are up. Examples are finance and insurance and lessors of buildings. The less than $1 million loans, non-accruing loans, are to industries that have higher risk. And overall, balances to risky borrowers have declined, but these non-accruals appear to be leftover pieces of the portfolio that banks could not exit. Examples of those are ag and retail. So it appears to be very obvious that the banks have de-risked their portfolio, especially at the smaller loan. You've gotten out of the industries and the type of borrowers that led you to 3-4% non-accrual rates back in 2008, 2009, and you're now attracted. You're still doing some small loans, not a lot, but some. But what you're doing are rated very better, or much better. Sorry. And small loans risk rated 4 or better, so loans rated 1, 2, 3, or 4, were in 2012 just 16% of the portfolio. They are now 30% of the portfolio, so almost double. So you've completely changed the mix when you're looking at the small business loans. So the current loans, that are going delinquent, the small loans that are going delinquent, are really for decent industries that tend to have delinquency problems every now and then. These non-accruals are for leftover loans that basically industries that you've exited. And I'd be happy to talk some more about that offline if anybody doesn't quite understand what I just said. We wanted to look at one other thing before we go to CRE. And as I was creating these charts, the inflation numbers came out at 7.9% for February, following 7.5% for January. So the Fed's claim last year that inflation was transitory is probably not accurate. And we did some research and gathered the following list of industries that traditionally are negatively impacted by inflation. And it's too soon to expect an impact to be displayed here in the February numbers, but we thought these would be a set of sectors for us to keep an eye on, and for everybody on the line to examine your level of exposure. You can already see that a couple of these are not performing very well. And high inflation, or continued high inflation, is only going to hurt these and prevent, for instance, the scheduled air transportation and the accommodation food services. Their recovery is going to be slowed. And then some of these other industries, and this typically falls into what people call consumer discretionary. Those are the type of industries that are going to suffer. And these are some of the larger ones that you see into that sector. So that's C&I results. So we'll move on to CRE. And we define CRE based on the interagency guidance, which basically says if 51% or more of the profits come from the sale or rental of properties, it's CRE. And you'll often hear this part of the CRE referred to as investor-owned real estate. And we're seeing, I'll backtrack a second. Over the pandemic, CRE was a little bit late to be impacted and has been slower than C&I to recover, both in times of percentage and also timing. And throughout at least the first half of 2021, the non-accruals in 90+ days past due have remained stubbornly high and higher than pre-pandemic levels. But now CRE appears to be headed in the right direction. Non-accruals are well under 1%, and the 90+ days past due and the 30 to 59 days past due levels are both half of what they were about 3 months ago. So it looks like the CRE portfolio is finally turning the corner. Pardon me. So here we've expanded a suggestion from Brooks Brady of Zions Bank and added a March 2020 here to give us a pre-COVID baseline. So for each of the largest property types, you see a dark blue, a light green, and then we'll call it gold. And the dark blue is the pre-COVID balance. And let's talk about lodging first. Its performance suffered the most, and while now improving, it still remains elevated, far above any other property type. So lodging is still having its issues. Now, the pandemic has basically been a non-event in terms of performance for multifamily, office, and residential properties. For health, industrial, and retail, non-accruals rose in 21, but are now back to or close to the pre-pandemic level, so they seem to recover. The only property type that seems to be headed in the wrong direction is mixed-use properties. It's gone from 0.07 pre-pandemic to now just over 2%. And most of the increase appears to be attributable to a single bank, but within that bank, they're experiencing issues in a number of locations. So again, we're going to keep an eye on this to see if it is just related to a single bank or if it's the beginning of a trend. And as by definition, the mixed use tends to be properties such as where you'd have, say, a 4 or 5 story building where the bottom is retail and the top are apartments, or there's shopping centers with apartment buildings on them. So things like that, at least for this one bank, but in several locations are having problems. And it's the several locations that has me a little bit concerned. So now we're going to look at non-accrual trend by geographical region. And we haven't looked at these for almost a year. And frankly, I was not expecting these results. These are another set of results that sort of puzzle me. We've known for some time that lodging has the highest non-accrual levels and that most of the poorly performing hotels were in New York City and Boston. So I was expecting the Northeast to be high in 2021 and then lower in 2022. If you remember just the previous slide, non-accruals for lodging had come down. But what happened in the Northeast is the improvement in lodging has been offset by declines for retail, residential, office, and mixed use. So kind of a all-encompassing issue in the Northeast. In the Mid-Atlantic, which is another region that's, in my mind, kind of went counter to what you would have expected, increase in 21, down in 22. We're seeing an increase in non-accruals, again, for mixed use, some retail, and also some retirement facilities. And the Eastern Midwest has elevated non-accruals for healthcare. But again, overall, kind of a little puzzling picture. So we want to finish up with an extended look at property values. Because you hear it, whether it's your home or your offices or warehouses, just the exorbitant prices that are being paid for real estate. And so we're going to take a look here at property values. So this chart, in my mind, should be Exhibit A for credit policy manuals, where you want to dictate that the maximum loan to value for any CRE loan should be 70%. Here we've calculated exposure to value for this chart. We do loan to value, we also do exposure to value, but exposure to value takes into account both the outstandings and the available balances. And it's quite clear And again, we're looking at March 2021, February 21, February 20. It's quite clear that throughout the pandemic, facilities with higher ETVs did not perform as well as those below 70%, and still are not. So that seems to be the cutoff. And you'll see that in a lot of documentation. Banks are putting the loan to value at 70% and holding there post-recession. So we wanted to look a little bit more at this. And again, you read the CRE trade journals, you hear about properties being bought and sold within a year for a huge gain. And we want to see if our data supported that. And from what you see here, we think it does. This chart is showing the average property value for loans in the CRE portfolio. And the calculation is very simple: total property value divided by number of loans. And since early 2021, the average property value is up 27%. And on the next slide, we'll take a look at this by the individual property type, because there are some differences. So again, the increase has not been universal. The multifamily, the office, and the industrial property types have risen considerably. Multifamily up almost 50%. The others are pretty much flat or up just a little bit. Mixed use values are actually down when you compare 2020 versus 2022. And I wonder if that has something to do with the increase in non-accruals. Retail is up a little bit. Again, another one that's surprising. And obviously office is probably surprising as well. But it just seems with people not going back to work, I think a lot of us were expecting office properties to drop, but they seem to be holding their own. So that concludes our discussion today. Just as a quick recap, performance overall for both C&I and CRE continues to improve, but there's still some pockets that were seriously impacted by COVID-related closures and remain high. And going forward, we're going to keep an eye on those industries that are subject to stress from inflation. And pardon me, as I mentioned, this was pretty heavy on performance. Next month, if you join us for our quarter-to-quarter review, we're going to take a look at some of the growth in the portfolio. So Carly, that's it.
Thanks, Tom. So we do have some questions. Actually, they're kind of the same question phrased differently, but how many banks are included in the data set?
So Elena, if you send me that question in an email, I can get that out to you.
Okay, and we also had an anonymous attendee. What's the sample size for the non-accrual data? Interesting that moves the needle so much.
So the answer to that is there in that given sector. Sorry, I'll backtrack. There are a couple of sectors where there's the data is in the low billions as opposed to the tens of billions. And you can get a big loan in there to move it for some of those smaller sectors that we have. Okay, great. Well, that is the extent of the questions that we got. If none other come in, would like to thank you, Tom, for sharing your insights, and thank everyone else for joining us today. If you're interested in learning more about Credit Risk Navigator and how it can provide deep insights like the ones presented today, please reach out to Tom, myself, or your RMA relationship manager, and we'd be happy to discuss with you. We look forward to having you at our next session on credit trends. Also, if you are unable to join our live demo for the new user interface for Credit Risk Navigator, make sure to watch that on demand by visiting the rmahq.org website. We had a great conversation regarding the new platform and how you can use it in real-time scenarios. This concludes our webinar. Please take a moment at the conclusion of the event to complete the post-webinar survey. Thank you, and we'll see you next month. Thank you.
Bye.